what the gold market's anticipating is a recession, and the gold market's anticipating the deficits are going to blow out even wider, and they will. So Trump and the team are going to try to hit the discretionary spending as much as possible, all the waste and fraud, which they say could be up to $1 trillion. During a recession, the deficit will widen. That's just the math. And especially if the stock market comes down. 25% of all tax receipts come from the stock market gains. So there'll be a widening of the deficit, and gold's anticipating that the Fed's going to do QE. That's what the gold market's anticipating.
You're watching Capital Cause, and my name is Danny, and today's guest is the founder of Finance Technologies, Ed Dowd. Ed, thank you so much for coming on, my friend.
Danny, great to be here. Thanks for having me on.
Yeah, it's a pleasure, Ed. I know you're a big name in this sphere, but I asked this to all of my guests. So for the one or two people who may be coming across you for the first time, if you can just kind of give us like a brief on your origin story, what got you here, then we kind of dig into some recent happenings as it relates to the markets, as it relates to the Trump administration, what you think is going on over there with RFK, et cetera.
Yeah, sure. I've been in the capital markets since my early 20s. I started off at HSBC Bank as a fixed income salesperson, went back to business school, then went to DLJ, Donaldson, Lufkin and Jenrette, did equity research right during the dot-com bubble. I was not in that. I was doing electric utilities, so I missed the boat on that party, but I saw the fraud in real time. Then I went to the buy side up in Boston, Independence Investments, as a tech analyst, navigated through the blow up of the dot-com bubble, then became a portfolio manager at BlackRock in 2002, took over a large cap growth fund with my partner, and we co-managed it from a $2 billion starting asset to $14 billion by the time we left. So that was 10 years at BlackRock. Moved to Hawaii, been entrepreneurial ever since. Currently founding member of Finance Technologies. And I came onto the scene initially during COVID. We started to do research into just excess deaths, excess disabilities and injuries. And we found that it was pretty crazy. And, we think it's the magic juice. Other people can argue with that. And then we've been recently focusing on launching a research consulting firm. We're also trying to raise money for a hedge fund, macroeconomic alternative hedge fund. And right now we launched our first revenue generating product January 9th, the U.S. economic outlook for 2025, dangers of a deep worldwide recession. So that's why I'm kind of on the circuit. Got early notoriety for my work and our work on what was going on during COVID.
Awesome. Well, let's just dive right in here, Ed. For you right now, what is the most topical thing on your radar screen at the moment? What should be front and center for investors out there?
Well, we put out the report January 9th, and honestly, when we put it out, we thought it would take some time for our thesis to, become more apparent. I think our thesis is coming to fruition quicker than we thought, and our thesis is pretty simple. We made a call in 2023, spring of 23, that we were predicting, according to our early cycle indicators, very quantitative, high-level work, that a recession was coming in 23, beginning of 24. We were wrong, and so were a lot of other hosts of economists as well. We asked ourselves, why were we wrong? Have the fundamental laws of economics changed, or are we missing something? So we reverse engineered why we were wrong. And what we discovered was unprecedented fiscal dominance, a little bit of statistical tomfoolery in the non-farm payrolls, and unprecedented government spending. And if you look at the last 2 years of the Biden administration, we were running 8% of GDP deficits, which are crisis level deficits. In the great financial crisis, we were briefly at 10%. So you had to ask yourself, what was the crisis? Well, the crisis was to keep the economy afloat into the election, and also fund what we've discovered, the elephant in the room, illegal immigration. We have 10 million border encounters, so we know of 10 million that came in over the last 4 years. It's likely 15 to 20, but let's stick with 10. Normal net legal migration is 1 million a year. So this really distorted the economy. And in our report, we detail how it held up the housing market to a certain extent, And all this is going to reverse under Trump. And the government jobs added were a big part of the payroll growth. And all that is reversing out. And it wasn't sustainable anyways, because the debt was growing too fast, and they needed to continually increase the amount of spending to keep this whole thing from falling apart. And the reason why we're surprised, it's happening quicker than we thought. You know, when Trump got elected, we already heard stories about self-deportations that showed up in New Tenant Rents, which is a series we follow that plummeted in Q4. It's a volatile series. It's done quarterly, but we think it's already an indication that we're going to see inflation starting to come down. When you bring in 10 to 20 million people and give them money, they tend to spend it immediately in the economy. And we've calculated back of the envelope math that if you bring it, let's just say 10 million, what's the economic all-in cost of bringing that person from Central America in? So you have to give them money through an NGO to get them from Central America to the Darien Gap, through the Darien Gap to the Mexican border, then over. Then you need to transport them somewhere within the U.S. because they all didn't just hang out at the southern border; they were put everywhere. Then you give them accommodations, then you give them food and clothing and money. So you could say, realistically, the all-in economic cost for one illegal immigrant was anywhere from $50,000 to $100,000, including all the NGO spend. And so that stimulated the economy anywhere from $500 billion to $1.5 trillion, which was funded through debt, U.S. Treasury debt, our tax dollars. So that's all unwinding. That's the big elephant in the room that really supported GDP growth along with government jobs. And the real economy has been struggling. That's why Trump was elected. It was minus 2% real wage growth going into the election. 1980, Ronald Reagan had the same thing, landslide. Bill Clinton had the same statistic, and he won. So the real economy has been weak, and that's why we made the call that it was going into recession, because traditional measures like PMI and a whole host of other indicators were pointing down. But they held it up barely, and this is all unwinding. It's all unwinding fast. You don't even need to deport the aliens. You just need to stop the flow. It's a second derivative thing. We've already seen the real economy slowing very fast. I don't know if you've seen, but you know, airline companies are already reporting earnings misses because government bookings are down 50%, and that also means consulting bookings are down 50% because a lot of the consulting business is with the government. And those are the marginal price setters because they're price insensitive because it gets paid for by the government. So this is happening fast, and the stock markets might be starting to discount this possibility. I know everyone says it's the Trump tariffs, but honestly, if you look at the stock market and the internal indicators, anybody who's been in the stock market a while knew that the breadth was awful. It was driven by 7 stocks. Semiconductors peaked in July of last year. So we knew this was coming, and it's a quick unwind. I think we'll get a rally here soon, but I think this is going to be a process. This is going to unfold over a long period of time. We think there's a housing problem coming. Home prices are probably going to decline. It's a fragile housing market. We have in our report, we have a lot of leading indicators that show that prices are going to come down. And you know, it's not the end of the world. I think a lot of people would benefit from lower home prices, and that might get the real estate activity to start moving again, because right now there's really no real estate activity. My friend in the escrow trust business, they live off transactions. They're at transaction levels below COVID.
Yeah, if you think about it, who is Trump's base really? It's non-asset owners, right? So for them, they actually benefit from seeing a depreciated real estate market or a depreciated stock market because it enables them to buy in on the cheap. So what do you make of this idea that's been floating around X recently, just around the internet in general, that this is all part of like some 3D chess move, i.e. to bring down the stock market on the stock market, you inversely bring down conversely bring down the 10-year yield. And that is the stated goal of Scott Bessent. And then you also have the tariffs coming on and off every other week. That creates uncertainty into the market. So that creates capital flow rushing into U.S. treasuries, which are more predictable. I've seen this idea being floated around recently. I don't know if you have or not, but what do you make of this notion?
Well, I don't think it's because they say they want to do that. The market was poised to do that. We put out a free piece on our website under resources. It's free. It was on the CAPE yield ratio of stocks, and they'd gotten to the dot-com bubble yields. It's the dividend yield, and it gotten very expensive, all-time high valuation. So every time it gets to this level, the forward 10-year returns are miserable. And bonds had already had a bear market for the last 2 years. So asset allocators are all on the wrong side of this. So it was poised to do this anyways. And when you have a slowing economy, the long end of the curve starts to come down. And 10-year yields and 30-year yields peaked on January 10th. And they've come down 50, 60 basis points since then, put in a nice bottom, what we call technically a monthly swing low on price, monthly swing high on yield. That's a very strong technical signal. So I think the 10-year and 30-year are already sniffing out this slowing economy. The stock market took a couple, that was January 10th, stock market peaked Feb 18th. So about a month later, the stock market figured this out. But it's true, if it becomes apparent to asset allocators we're going into a recession and there's a risk-off scenario coming, and it won't happen all at once. We're not predicting a crash. We're predicting more of a 2000 to 2002 slow, bear market. If that happens, you get a recession, yields will come down, and asset allocators will reallocate. But the notion that that this is 3D chess, it was going to happen anyways. If they had kept their mouth shut, it was going to happen.
Whether it be Trump or Kamala.
Yeah.
Gotcha.
Well, Kamala would have been more of the same, but then we would have had a currency crisis eventually. So that's why Trump is trying to restructure the economy. We would have had more of the same under Kamala. It may have lingered a little more. They would try to pad the numbers, but it would eventually show up in the currency, and the dollar would get absolutely hammered.
Gotcha. Is this why gold's also seeing a bit up? Just recently, yesterday, it hit an all-time high of $3,000, the magical number. Is that because the coming down? Is there something else bubbling beneath the surface there?
Well, if gold is a proxy for money printing. And what the gold market's anticipating is a recession. And the gold market's anticipating the deficits are going to blow out even wider. And they will. So Trump and the team are going to try to hit the discretionary spending as much as possible, all the waste and fraud, which they say could be up to $1 trillion. During a recession, the deficit will widen. That's just the math. And especially if the stock market comes down. 25% of all tax receipts come from the stock market gains. So there'll be a widening of the deficit, and gold's anticipating that the Fed's going to do QE. That's what the gold market's anticipating.
If you're looking for great deals on gold and silver, coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
I
see. How low could they take it, though? What is R star in this case?
So, how low could they take what?
How long could they take the Fed funds rate down?
How many basis points? Yeah. So we think the Fed's behind the curve. They've only cut 100. They need to cut more. We think they're not going to cut next week. I don't think they're going to cut. And then they'll start chasing it down as the economic weakness really starts to manifest. I think Fed funds rates settle anywhere between 2% and 3%.
Gotcha. You also mentioned Doge. over the last week or so, we had the State of the Union address, and Trump kind of rattled off all of the savings, like things along the lines of $500 million for, I don't know, transgender surgeries in Mongolia and things like that. But all of these things are like in the hundreds of millions of dollars, tens of millions of dollars. I mean, don't we really need to kind of put the pedal to the metal here and start cutting into billions, tens of billions, hundreds of billions? You alluded to a trillion.
Well, what I think is not being said is Doge got in there a lot faster than I thought. When we wrote the report, I was under the assumption Doge would have to be congressionally approved, and we wouldn't be hearing from Doge until later in the Trump term. But they repurposed U.S. Digital Services Program and rebranded it. They had the keys to the IT data sets, and they got in there way faster than I thought. And what they've uncovered, and I think there's been a lot of shocking discoveries. Personally, I think they're holding back a lot of the fraud. And if you believe what I said about illegal immigration, that was washed through the NGO system. And I think there's a lot of fraud going on that is being looked at. And my opinion is they're going to be able to find a lot of fraud, but they may not want to publicly disclose it yet.
Interesting. So what would be the rationale behind that?
I have no idea. Maybe because they don't want to, if the number's too big, it could be shocking and scandalous and disrupt the bond markets.
I see. No, one of the candidate you backed in the past 2024 elections, RFK, is now the head of HHS. What do you make of his current tenure? Is he buckling down on some of the things that he promised at first? I know we're on YouTube. We can't get into the stuff the juicy stuff that you alluded to, but it seems now like he's more focused on food as opposed to the pharmaceutical industry. Is that a pivot away from? Is there a sequence of events that you think he's undertaking? I.e., let's attack the food lobby first because they're probably a lot weaker than the pharmaceutical lobby, or is this kind of a compromise that he's had to make in the process?
Well, Maha is independent from him. I mean, he has his own agenda, but Maha definitely is messaging food over the other pharmaceutical products, so to speak. And a lot of people in the medical freedom movement are miffed about that. The story during the campaign going into once Kennedy and Trump joined, the story was, look, we want to get elected. We'll take care of things after. And now the story is, well, it's going to take time. We got to get him confirmed. So there's definitely a lot of wrangling in the medical freedom community. People are upset that this issue is not being addressed because a lot of people supported Bobby for that. I suspect there's a couple things going on. First of all, Trump has never really admitted that Operation Warp Speed was a disaster, and he's never admitted anything about the magic juice. So there seems to be a compromise, but we have to give Bobby some leeway to hope that he figures out a clever way to figure out how to get that taken off the market.
I see. What's your general sentiment on the Trump administration's performance thus far in the last 2 months? Go ahead.
Yeah, look, it's mostly, I'm 60% happy, 40% mildly disappointed. I mean, there's some missteps when they did the Trump and Melania coin. That bothered me. That's just kind of shady. Their messaging needs to be a little tighter. Scott Bessent is doing a great job of messaging. Others doing less of a good job, and they need to just kind of be all on the same page. I think this tariff stuff is more a negotiating tool, but if the stock markets wobble and you're doing this crazy stuff with the tariffs, which I get, it's negotiations, you can be blamed for market moves. I think it's the tariff stuff the tariff talk should be downplayed, and it should be done more behind closed doors, that kind of thing, so that we're not constantly seeing headlines and tape bombs every 2 seconds. But for the most part, they're moving fast. I know a lot of people in the MAGA community are upset about the Epstein files and no arrests and all this, but they've only been in there 9 weeks.
Right. What is the rationale behind, you mentioned the tariffs. What is the rationale behind tariffs on Canada, Mexico? What's the grand plan? Is it really to make Canada the 51st state? Is it really to build a fortress America in the Western Hemisphere, i.e. the north-south axis, as opposed to the east-west, which we've been living in for the last, post-World War II era, right? The transatlantic axis. What do you make of Trump's kind of realignments of geopolitics lately?
Well, obviously, the tariffs are a geopolitical tool, and one of the major things he's using them for is to stop illegals from getting in over the border and the flow of fentanyl and to clamp down on the border. And he wants the Canadians and the Mexicans to use their own resources to do it rather than spend US dollars to secure our borders. So the tariffs are kind of a big stick approach. There's also trade considerations. Whether Trump wants to make Canada the 51st state, that sounds like a classic Trump, art of the deal, say something crazy and then come to the middle. Now, maybe he does, and I'm not privy, I'm not in the room, but this all smacks to me of forcing Canada to the table and getting what he wants, which is a secure border and a fair trade deal. Canada currently imports about $400 billion into the U.S. We export about $340 billion. So it's only a $60 billion trade deficit, but and for us, it's a rounding error in terms of our total GDP. We're 29 trillion. Canada's 2.5 trillion. That's their GDP. So, 400 billion of 2.5 trillion is a big chunk. So we have a lot of leverage. So this is a leverage tool.
And aren't these tariffs in a sense reciprocal as well? I mean, doesn't Canada already have tariffs on us as Americans?
Well, I don't know that. I've never gone into what the trade deals look like that have been struck previously, but if you listen to the Trump team rhetoric, they seem to be one-way deals, and so Trump's trying to correct that. So if you believe what they're saying, so that's kind of my understanding of it. That it's not a fair deal to the U.S. At least that's the political speak at the moment.
Right. Now it seems like this back and forth between Zelensky and Putin in Europe, it seems to have kind of revitalized the European defense economy over there. What do you make of the European economy? I've been hearing a lot of talk from some of the people that I interview here that there is weakness in the market there, especially with regards to potential bank failures. You're seeing gold flee out of the LBMA. You're seeing gold flee out of Switzerland and into the United States. Are you seeing any signals coming out of Europe that point to weakness in the markets, the economy, or anything that could potentially be a continued spread across the globe?
Yeah. So Europe is a zombie economy zone. They really never took care of their banking issues, and the UBS was forced to buy Credit Suisse, as we all remember, in 23, and they took on that disaster derivatives book. They're now going to merge all that on March 4th. I think it's today. So they're going to now report. It's all in there. All the garbage from Credit Suisse is on their balance sheet now. So the Credit Suisse problem didn't really go away. It just got absorbed, and UBS was forced to buy it. So there's this looming problem in Europe, banking problem. There's definitely weak economies. Their stock markets seem to be still hanging in there. And there's a lot of hope and speculation that if Germany starts increasing its defense budget, everything's going to be fine. The gold coming to the U.S. is interesting. I actually tend to like Martin Armstrong's take that they're putting it over here because they're predicting a war is coming, some sort of war, which that's not good if that's the case.
Yeah, if you read the headlines, it certainly points that way. Britain has talked about sending boots on the ground in Ukraine. Estonia has talked about mobilizing its military and air force, which, according to one of my Get Jump on Me, has only 4 airplanes, 4 jets. Sweden has called for military conscription. So the wind does seem to be blowing that way. So much to your point, the smart money could be looking for a way out of Europe. Now, if we do have a big war that blows up over there, maybe not tomorrow, maybe not next week, maybe not next month, but maybe in a couple years from now or a year from now, I don't know, XYZ timeline. What happens to European capital? Could European capital come and flow into the United States, and by virtue of that, prop up the U.S. market? My good friend Martin Armstrong often brings up this point of fact during World War II and after World War II, after Europe was ravaged, a lot of that European capital moved to the U.S., and that was pretty much jet fuel to get the U.S. skyrocketing up to being the new world power. Could a warring Europe revitalize the U.S.?
Well, I think that would reverse capital flows. But right now, if you looked at the flows from foreigners into the U.S. stock market, were at record levels. So temporarily, as we go into a recession, that's going to reverse because it has to, and that'll cause a weak dollar for a time. But if there's a war, capital will fly over here in a heartbeat. That'll happen super fast. Look, let's say Martin Armstrong's right. The gold's coming over here because they're getting ready for war. And if you look at the headlines, the talk coming out of the leaders of the UK, France, and Germany, it's almost like they want a war. And so you have to ask yourself, why would you want a war? Well, maybe because their financial situations are so bad, you need a war to cover up a potential collapse. And if you look at the UK has been doing emergency overnight operations for well over a year, extending liquidity to probably zombie banks. So there's problems.
And what of China? China, as have we seen? Because there's this idea out there that the U.S. wants to offload the war in Ukraine against Russia to the Europeans because they want to set their sights on the Indo-Pacific, i.e. China. How does the Chinese economy fare in this case? They've been taking quite a beating for the last couple of years. Where do you view the health of the Chinese economy at this current point in time?
Yeah, so China hit a demographic wall in 2020, and demographics are destiny. So they're on a demographic decline. You see that in their real estate market, which was a big part of their boom for the previous 10 years, 2010 to 2020, and it's going the wrong way. And what's been holding up their economy are large project completions. In our U.S. economic report, we talk about European and Chinese home prices, global home prices, and real estate prices. And the completions of the Chinese projects are going to be coming to an end soon. So there could be the housing crisis and real estate crisis in China could go to the next level. I think China is already preparing for that. They've already started injecting liquidity into their banks and propping up their banks. So the Chinese economy is going to probably continue to struggle. And if China struggles, then, other industries, close to them like South Korea, Japan, other economies will suffer as well.
Gotcha. And one more thing on the topic of Europe, there was a recent news item the other day. I can't remember who said it. It was some leader within the European Commission, and they said they may have to tap into somewhere north of $10 trillion of European citizens' savings to militarize Europe. Did you hear about this?
Oh yeah, let's break that down. Let's unpack that, because that just made me so angry. They called it unused savings. Let's think about what that term actually means. Savings, by definition, are unused capital for future use. So I don't understand the term. It's literally it's theft, and it sounds like bail-ins to me. Sounds like we're going to be seeing some bail-ins. That's what it sounds like. And I think Christine Lagarde was involved in this, and she, that woman, when she speaks, look out.
Yeah, the masters of euphemisms for sure. I mean, if that isn't a signal to get your capital out of Europe, I don't know what is. Again, I'm not a financial advisor. That's just my opinion. But I mean, wouldn't that be a huge signal to that we're on the precipice? I mean, like an early warning indicator that we're on the precipice of a major catastrophe in Europe?
Yeah, I think there are signals coming out of their mouths that suggest that we are, because when you want to go to war, war is usually to cover up financial problems and internal problems. It's a way to reset your economy. And this talk about stealing savings, there's something nefarious going on that we're not aware of. And again, UBS just took their, the Credit Suisse derivatives book onto their balance sheet. And we don't know what kind of nonsense has been going on for the last 20 years in the derivatives market, and it's kind of been a pretend market for a while, pretending that their balance sheets are okay. Eventually, this toxic junk has to be cleared and sold.
Mm-hmm. Now, taking it back stateside, I'm noticing something interesting going on. Yes, we're having all these tariffs come into play, but the oil hasn't responded in a way that most people would find predictable. It's actually gone down a little bit. I think it's $67 or 67 some odd dollars or something like that. $68 at the time of this recording. The other day on Wednesday, you also had the CPI report come out, giving you a 2.8% print for the month of February. It's not too bad compared to where we were before. Of course, the largest component in that index was the price of eggs, up a whopping 58%. But if you look at the up-to-date Trueflation numbers and other inflation metrics out there, egg prices have actually started to come down. So what's going on here, Ed? I've heard so many people talk about how these tariffs were supposed to be inflationary, but they're appearing to be somewhat disinflationary, maybe even deflationary. What's going on here?
I think the tariffs are coincidental to the inflation numbers. Inflation is coming down because economic activity is rolling over. And if you look at new tenant rents, which I talked about, that eventually gets into all tenant rents, and that's a big component of shelter. And shelter's like 37% of the CPI number. So inflation, we expect to come down throughout the year. I think inflation will print a number sometime in the fall, early winter, sub 2%. So inflation is an interesting thing. I don't know if you remember, but I remember quite well during the 2008 financial crisis, we had sky high oil prices, and oil peaked in June of 2008, and we printed an acceleration of inflation. May, June, July, August, and then everything just stopped and fell out of bed. So inflation, I think, is rolling over. The economy is contracting. There'll be credit contraction. And when we have credit contraction, we get disinflation to deflation. So I think that's already in motion. And the 10-year Treasury yields are telling you that. They peaked on January 10th. We're already down 50 basis points on the 10-year. So I think the Trump tariffs are just coincidental. And, economic growth slowing is going to bring down inflation.
Mm-hmm. Now, what do you make? Let's bring gold and precious metals in general into all of this. We've seen the markets make a pretty significant correction thus far, and the NASDAQ being the most victimized out of the three big ones, both S&P and, of course, the NASDAQ. However, gold and silver have continued to rally higher. We mentioned the $3,000 part of gold. There's a $34 handle on the part of silver. Now, gold, again, we've alluded to the fact that it appears to be a flight to safety mechanism. Silver, on the other hand, is also catching a bid, which to me kind of doesn't that signal an inflationary future in a way? Because if you look at the last round of inflation, the last big wave of inflation we had, I want to say, what was it, in 2022? It was preceded by a huge jump in the gold and silver prices. So gold and silver were kind of like the leading indicators before that inflation took place. What of could the precious metals be signaling are they sending a counter signal towards more inflation? How does that work out?
Well, gold goes up and down for a variety of different reasons. And if you look at commodities, the commodities basket, the CRB, it peaked in June of 2022. And it came down into 2023. It's been going sideways. And the price of oil is indicating economic activity may be going the wrong way because, with all this geopolitical tension, oil should be spiking. So I suspect oil is telling you something about the economy. Gold's telling you something about the financial system, that we're getting close to some sort of new financial system where gold might be part of a new system. And also gold could be anticipating, like I said earlier, a huge amount of quantitative easing and money printing in a recession. Right now, we're not doing QE. Gold may be anticipating QE coming back quick.
Which would be inflationary, of course, right?
So our call is this. We're going to see a deflationary scare, which is a correction in the stock market, the asset markets, but we don't know what the policy response is going to be. And the policy response is going to be the Federal Reserve and fiscal spend to take us out of the recession. Once we see those, we suspect we're going to have an inflationary problem again. So we're going to have this roller coaster of deflation, inflation. We're kind of at the end of the system. The system is just so rife with too much sovereign debt, that you can't raise interest rates for too long to fight inflation without having a deflationary scare, which is what we're getting. And the only reason we didn't get it earlier is because of the government spending that we did the last 2 years. But we're close to the aha moment, the deflation scare, and then the massive policy response, which at that time will flip bullish and talk about inflation.
How do they respond?
I mean, bullish on risk assets, but obviously the middle America won't like it.
So you're anticipating, just to make sure I have it correct, you're anticipating that they respond by money printing, which wouldn't that create I don't want to say hyperinflationary scenario, but wouldn't that create a very inflationary scenario as well?
Yeah, not right away. You got to remember, monetary policy has an 18-month lag. When we did the COVID printing in 2020, about 18 months later, that's when inflation inflected and took off. So it takes time for the mechanism to work. So first we get the pain, then we get the inflation, and gold. The one thing to say about gold, in the 2008 great financial crisis, gold was on a bull run from 2002 into 2008, massive bull run. And then gold corrected 50% because there was a credit event. There was a systemic credit event called Lehman. So gold went down 50% because people had margin calls and they sold what they could, not what they wanted to. So just, there could be, if this turns into a credit event, a systemic problem, which we're not calling yet, gold could take a nice hit, but it will, recover and go back to all-time highs. But, gold is not the perfect hedge if there's a systemic, credit crisis.
What would be a better hedge?
Cash, if you're predicting that. Warren Buffett is, I'm sure he owns some gold, but Warren Buffett's got $390 billion of 3-month T-bills.
It went up to 390. I thought it was 320 some odd.
I thought the last I saw was 390,
Wow.
But maybe I'm wrong. Don't quote me.
Wow. Well, even if that is the case, 320, 390, whatever it is, I mean, that is a significant position. If you juxtapose, I was looking at the graph the other day. If you juxtapose the Warren Buffett cash position on top of the S&P, it almost perfectly kind of matches it. So the higher the S&P goes, so does his cash position. So Omaha, the Oracle of Omaha.
He's not a market timer. He started building this a year and a half ago, but he's been around a long time, and he knows how the system works. And credit creation is the lifeblood of the economy. And when credit creation, usually the punch bowl gets taken away by the Fed, which the Fed did already. The Fed took away the punch bowl. We should have already had a recession. We didn't. And now the hangover is going to be a little bigger because of this fake government spending that's all being taken away. So Warren Buffett was a little early, but he understands there'll be an economic recession, potentially some bank failures and some panic and fear. And he's going to do what he did in 2008. He's going to come in to like distress great companies and be the hero and get these great convertible bonds, preferred dividend bonds, and make a boatload of money.
How do we deal with the 37 trillion dollar debt? I was just interviewing Rob Keens the other day, and he this FASB program where they identified $20 trillion in missing money that was allocated to HUD and the DOD. And then if you extrapolate that out to the rest of the government, then you're looking at $100 trillion. I don't know if you've heard about this or not, but even just looking at the 37 trillion dollars in sovereign debt, how do you deal with that? How do you get the United States, over the rainbow, so to speak?
Well, right now, the debt to GDP is the most important metric. We're 120%. So right now, every government spending that we do the debt doesn't really add to the economy. It actually kind of subtracts to the economy long term. We got to get it below 90%, and there's two ways to do it: cutting and growing the the revenue of the country. So my guess is, and this is going to be a difficult thread to needle. Trump has to restructure the economy. The deficit is going to blow out during the recession, but as long as he cuts discretionary spending and restructures the economy, and we have growth on the other side, we can grow our way out of this. If we don't, then it's disaster time.
And how much time does he really have? Because you often hear the claim that he doesn't have 4 years, really, because there's a lame duck period at the end of his 4 years.
He's got 2.
Then 2 years.
Yeah, he's got 2. Yeah. Look, this is a very stressful time for a lot of people that are involved in capital markets. And a lot of people don't really understand what's really going on. But the next 2 years are going to be very important. And if Trump fails, we got problems.
I see. I think we've covered pretty much everything I had in line here. Ed, anything else that you want to cover that we didn't get to before we wrap up?
No, I think we hit most everything.
Awesome. Well, tell people where they can find you. Drop us your socials if they want to hear and see more of you.
Yep. If you're interested in our report, it's priced for institutional investors, high net worth individuals, family offices, and RIAs. So if you're interested in that and you can afford it, it's at financetechnologies.com, spelled with the PH. I'm found on X at Dowd Edward, DOWD Edward, and Getter at Edward Dowd.
All right. We'll have the links to all those down below. So be sure to check them out, guys. If you're interested, if you enjoyed this podcast, give us a like and subscribe to the channel so you don't miss an episode. Right. Go, Ed, go in the comment section. If you agreed with Ed's analysis, if you disagreed with anything, let me know. I do read the comments. So always interested in getting your thoughts here. And then check us out on Substack. It's capitalcosm.substack.com. The link is actually right there, right beneath my name tag, where you can get early access, ad-free versions, where you don't have to suffer through the YouTube ads, and uncensored versions of all of my podcasts that warranted. And then finally, check out our partners over at Pimbex. That's PIMBEX.com for all of your gold and silver buying needs. Really gotten a chance to know these guys. Really like them. Great prices, great people. And if you support them, you support the channel in a direct way. So, all right. Well, that's all I got. Thank you guys for watching, and I will catch you in the next episode. Bye, y'all.